Good afternoon. Good afternoon. It's Monday, the 23rd of February. My name is Silan Vikramasinghe. Welcome to another edition of Monday Market Picks. Welcome back from Chinese New Year break. Gong Si Fa Chai. I take this opportunity to wish you great fortune and happiness in this year of the fire horse. Now, we are back to tariff tantrums again after the US Supreme Court ruling and President Trump first imposed a 10% unilateral tariff and then a 15 and raised it to 15% blanket tariff after that. So what does that mean to existing trade deals and also to countries with lower tariffs? Nothing's clear at this point, but this is exactly the sort of geopolitical uncertainty Singapore's 2026 budget was actually seeking to address. The budget was announced just before Chinese New Year, so we think it's important to have a deep dive into this. We have economist Brian joining us to take us through the details, and I will take you through the stock implications and the stock winners from the budget as well. Now, the budget, equity market friendly measures, is very supportive for small and mid cap names. And we have two names, a new initiation, Addvalue Tech, as well as Marco Polo Marine from Jarek, and we'll go through those two stocks. And there's also been quite a bit of activity in the ASEAN internet sector. We have Husseini to take us through the implications of what that means for C Limited and Grab. Plus, we've got two fresh trading ideas from our chart guy as well. So a lot to go through. So let's start with Brian. Brian, welcome to the show. Now, Singapore's 2026 budget was presented in 12th February, just before Chinese New Year. I mean, there was a lot in there, so there's a lot to unpack. What are some of the key measures that was announced to strengthen the Singapore economy's competitiveness and resilience in the face of AI, as well as all this geopolitical uncertainty around the world?
Okay, yeah, no, it's fine. Yeah. Okay, yeah. Well, I think that we would do well to focus on the medium-term measures. So
Hmm.
boosting AI adoption, helping businesses to harness AI, and also internationalization will key focus of two key focuses of the budget. So I think on AI, it's quite encouraging because we see measures not just to help businesses, but also to help workers. So at the broader level, a set of national AI missions for manufacturing, transport and logistics, finance and healthcare was launched to help guide AI transformation efforts in these sectors. And for promising companies that are willing to really use AI to do end-to-end business transformation. There was a new Champions of AI program which was announced to help provide tailored support. And for SMEs, there's help as well in the form of enhancements to the Enterprise Innovation Scheme, more tax deductions for investing in AI solutions, and also the Productivity Solutions Grant. And well, I think beyond business adoption, there was also measures to help raise the AI fluency of the workforce in the form of the Tech Skills Accelerator being expanded to support AI skills training. On international expansion, I think that's especially relevant right now because of the rising trade tensions globally and then also increasing competition in our domestic market. There were stronger measures to promote, help businesses deepen presence in overseas markets and also diversify into new markets. So we saw this in terms of an enhancement to the Market Readiness Assistance Grant, and then also the Business Adaptation Grants and Global Innovation Alliance schemes. So there is a complete suite of measures on this front, Dylan. And I think finally, we can't talk about resilience without talking about defense. Given the
Hmm.
rising geopolitical tensions globally, even in our neighborhood in ASEAN, the government did say that it is prepared to step up defense spending beyond the usual 3% of GDP if the need arises. And I think finally, this, about resilience, there's also this question about fiscal dry powder, especially in the context of the 15% tariffs being announced. that actually is higher than Singapore's initial 10% tariff rate. And I think what more is that it also increases uncertainty for businesses because there are going to be, national security and also unfair practices probes being rolled out on many countries across the world. And that may impact Singapore as a trade-reliant nation. What's encouraging is that in the budget, we saw that the FY 2025 overall budget surplus was revised up sharply from 6.8 billion, that's 0.8% of GDP, to 15.1 billion Sing dollars, which is 1.9% of GDP. And this higher than expected surplus can be used and can be drawn upon in the current electoral cycle in order to unveil more support measures for businesses and workers if necessary. Back to you, Dylan.
Thanks, Brian. And exactly. So, I mean, I think, when we talked about Singapore strategy, one of the main things we talked about was Singapore's certainty premium. And I think this weekend's, events really kind of highlights that again. As Brian said, there's a significant amount of dry powder that the Singapore government has to come out and support, when this uncertainty happens. So I think that's actually a good segue to the equities market. If you actually look at the budget itself, there's about $4 billion of directed equity market related funding that is there. About $1.5 billion is to actually expand the EQDP program to $6.5 billion, and also another $1.5 billion for the anchor fund with a mandate to bring in high quality IPOs to Singapore. Plus, the new CPF lifetime retirement investment scheme has a higher weighting towards equities for the younger demographic. So again, that'll help with the equities market as well. So at the macro level, these are all very positive for market liquidity and also can help raise the base valuation that Singapore has to a higher multiple. And I think, this further, adds to our 5,600 STI target for the end of the year. Financials should see improved credit conditions from more balance sheet flexibility from corporate tax rebates, overseas expansion grants, and AI deployment, which could lower cost pressures for a lot of the small and mid caps in Singapore, and also improve revenues and reduce NPL risks for the banks as well. And also the increased capital market support should drive more listing activity and trading, which is positive for SGX and iFast. Now, healthcare stands to benefit as well, given that one of the national AI missions is specific for healthcare, and plus there's expanded enterprise innovation scheme covering AI spending as well. So stocks like Thomson Medical and Raffles Medical should benefit from this. Mass market retailers like Shen Xiong should continue to benefit, even though the overall consumer, measures are a little bit less, especially CDC vouchers than 2025. We think they will continue to benefit given the targeted measures that are in place. And Brian mentioned higher defense spending and big allocations also to research and development. And all of this should benefit the industrial names like ST Engineering, as well as Addvalue Tech, which I will expand a little bit more later on. Now, in property, the REITs and developers should see stronger demand for business parks, R&D spaces, data centers, amid all this AI development and push into higher value added activities. Industrial and logistics REITs will be the key beneficiaries. Ascendas REIT, Keppel DC REIT, as well as office REITs like CICT and K REIT. The absence of additional property cooling measures is also positive, which we think will help the developers keep sustained demand levels. Also, tech manufacturing should see a boost from all these AI tax deductions, driving semiconductor capex higher and equipment demand higher. So look for names like AEM, UMS, and Franken. And then finally, the telecom and internet players should also benefit indirectly as enterprises scale AI, cloud and cybersecurity, and supporting the digital services arm of Singtel as well as StarHub. So quite a lot of sectors and quite a lot of stocks benefit from this budget. Do have a look at our very detailed note in our newsletter today. Now, with that, let's move on to Addvalue Tech. Jarik's on the road, so I will kind of cover this stock. Again, we think this is one of the key beneficiaries of the small and mid cap plays. We're initiating with a buy with a 12-cent target price, which roughly implies about 40% upside from current levels. Very attractive given the growth profile as well as the earnings visibility. Now, this is a rare profitable growth name in both the space sector and the drone sector. The company is a turnaround story, setting the stage for sustained earnings going into this year. The revenue outlook looks very compelling. We're projecting 42% CAGR between 2025 and 2028, supported by increasing satellite launches, particularly from names like SpaceX, as well as rising sector activity. Earnings could actually scale even faster than sales. We expect profitability to grow at about 80 to 86% CAGR, reflecting the operating leverage as volumes ramp up. There's a record $26 million order book, so we are pretty confident of near-term delivery and revenue visibility. The satellite business is riding on the surge of satellite launches, benefiting from a demand for in-orbit connectivity. Meanwhile, the drones business is rapidly growing because of the demand for anti-drone and RF sensing solutions, which is a structural theme given all the conflicts that are ongoing right now. So at the core of this is a very high margin turnaround story, which is at an inflection point, leveraging two very powerful themes, space as well as drones, which are both right on time in this current market. So we think the current valuations not really reflecting all this growth, even despite the fact that the stock has run quite a bit. So do have a look at our buy call and Jarik's detailed research report in our newsletter today. With that, let's go on to Marco Polo Marine. We are maintaining buy on this stock with a 20-cent target price. That's about 30% higher from here. We think that Marco Polo is really entering a rapid growth phase starting from this year all the way to 2030. First quarter numbers came in quite strong. Revenue was up 27% year on year. Gross margins expanded to 14%, driven by the higher margin chartering business. And I think this momentum is set to build even further. We're expecting the second quarter and third quarter to be even stronger in line with seasonal strength. Chartering is clearly doing really well. Fleet utilization has improved to 76% despite the larger fleet, supporting both revenue as well as margin expansion. The shipbuilding segment should start to matter more in the second half of this year, adding another leg to earnings support. Longer term, we see upside from the development of the next generation CSOV Plus, which could meaningfully lift profitability for 2028 and 29 onwards. We also take comfort in the fact that we've got a very high profile marine industry veteran taking a stake in the company. He's had a very good track record of entering and exiting companies in this sector. So that is an added vote of confidence as well. So overall, Marco Polo is back in a seasonal upcycle with improving utilization, better margins, expanding capacity, and visibility growth as well. So all of this put together, we think earnings are in for some strong growth going into the next few years. So we reiterate our buy call. Now with that, let's move on to Hussaini and the internet sector. Now, there's been a lot of activity, Hussaini, in this sector lately. C hosted an analyst briefing. You actually hosted a call on with the team from Cube, and Grab reported their fourth quarter numbers, and they also acquired Stash in the US. So help us guide through what all of this means for C first and what your ratings are, and then what it means to Grab and what your ratings are.
Sure. Thanks, Ilan, for having me. Maybe first for C. So yes, the company hosted a analyst luncheon It went on for almost 2.5 hours. So before that, let me step back and maybe put out like what are the key concerns on C Limited. So few of the key concerns, and that's why the stock is down, was that first was the competition from TikTok Shop. There was a huge divergence, and there's some alternative data points suggesting that although Shopee is growing at 20+%, but TikTok Shop is growing at say 60 to 80%. So that was one concern. The second concern was on the means we had seen that the US companies, especially the companies which are in the companies which are exposed to AI disruption had seen quite a bit of share price pressure. So those were few of the key concerns when we entered that briefing. Now, where management highlighted, these are the three key takeaways from the briefing. First is that management is not that concerned on the TikTok Shop growth divergence. They are of the view that uh, although TikTok Shop is growing at a faster clip, but they don't see that TikTok Shop is disruptive or quite irrational in their approach. They are of the view that TikTok Shop is going more into the rural areas, and as such, their core base of urban areas remains intact. So they don't see too much concern. In our call with Cube, they also highlighted a similar takeaway that although TikTok Shop is growing faster, but they don't see the corresponding impact on Shopee's categories, GMV categories. So that is kind of reassuring that TikTok Shop is not irrational. Further point to add over here is that we had seen TikTok Shop increasing the take rates uh, in January as well. So as such, that was positive. The second takeaway from the briefing was that we find company or the management in a bit of an uncertain or urgency mode linked to AI. They are creating within the company, there has been a quite a bit of urgency that AI could be a potential disruptor. It's quite an uncertainty, and they wanted to put or guide the business model in such a way that rather than them being disrupted, they take advantage of that. So companies working quite a lot on that side. Uh, but in the last week as well, there was an announcement that they have tied up with Google to to such that Shopee will appear in Gemini's search results. So they are taking steps on that direction. But as such, the company remains quite in a bit of urgency mode in that space. And finally, uh, we don't think uh, that Shopee is likely to guide the margins for 2026 when they report on 3rd of March. Now, that's kind of a uh, bit worrying for the investors, but in our view, it is not the case. Why they are not guiding for the margins is simply because they wanted to keep optionality uh, to spend more to align the business model in the AI space. It is mainly because of that. It is not because of competition. So net, we came out positive from the briefing, and we maintain our buy on the name.
Got it. Excellent. Thanks, Hussaini. Now, with that, let's go on to what our chart guy says. We've got PC Partner Group, where he says that the PC Partners pullback phase has once again found support at its 21-day EMA. So I think he's calling for a trading buy on this stock from this support level. He's also calling for a trading sell on Leong Asia. Prolonged sideways movement in the stock price since January 2026 suggests that the prior strong uptrend may be entering an exhaustion phase. So probably time to take some money off the table there. With that, let's also have a look at what's happening around in terms of events. We've got some big results coming out, very, very busy week for results. UOB out tomorrow, followed by OCBC on the 25th. SIA also reporting on the 24th, as well as Genting Singapore. So getting a clue on the overall tourism complex in Singapore as well. Plus ST Engineering, I think, again, quite a important STI stock out on the 27th of February. With that, unfortunately, we are out of time today. Thank you so much for joining us. And thank you for your support. And again, Gong Si Fa Chai, and see you next week.